It's been a glorious success story. Mexico, often maligned, has done better than good in the past decade. Their stock market is outperformed the stock market of the U.S. set in U.S. dollars. And then suddenly it's over. Oil south, exports to America, challenged in the peso, depreciating. Gerardo Rodriguez joins us from Blackrock. And I think one of the great shocks here to Americans is Mexico's stock market in the last 10 years, converted to U.S. dollars, has actually beat the S&P.
Yeah, it has
I think few people know that.
Yeah, it has been a nice story all along. But actually, when you look for the next 10 to 15 years, the reform agenda and what the government has been able to pass through Congress on competition, on labor, right, on energy, on telecom, actually are changing the landscape for the years to come.
What kind of markets are Mexico? Have they reached escape velocity from an emerging market to a less than emerging market to a more developed economy?
So Mexico has been living with these two economic realities. One, which is the medium-term, really nice, reform-driven economic prospects. But that's a story for the next 10 to 15 years. And then there's the cyclical story, which hasn't been that positive for Mexico, because Mexico, given its connectivity through trade to the rest of the world, the lack of export growth momentum has hurt Mexico. So growth projections have been revised down for 3 years in a row. Right now, it looks like we're at the bottom of the cycle, and the next set of news hopefully will go.
Brendan, it sounds like a story of Brazil.
Well, a little. I would actually argue that Mexico has been doing an amazing job of moving its economy towards manufacturing. We saw, I think, in the last year, manufacturing outputs overtake oil exports. I think I have that chart right. But I'm curious, what do they need to do policy-wise to stay on that trend?
So Mexico is a very good story on the manufacturing space, but related to auto and auto parts.
Okay.
Now, the challenge is moving up the value-added chain in the manufacturing space. Now, but you need to add some additional elements to the growth dynamics on top of the manufacturing. And that's where energy, that's where infrastructure is going to be in play for the next 5 to 10 years in the country.
Gerardo, there was a bit of a tantrum, an emerging market tantrum in January about 12 months ago when there was talk of the first interest rate increase, when that became more of a reality. Where is Blackrock positioning itself to be ready for any kind of tantrum that might occur, and where would that tantrum occur in emerging markets?
So when you look at what can happen when the Fed starts raising rates in the emerging world, what we see is that markets have already doing some of the work in anticipation to that, starting in 2013 with taper tantrum. Currencies are significantly more depreciated. Growth has slowed down. Interest rates have gone down. So there's plenty of space for emerging economies to accommodate to a tighter financial condition environment led by the Fed. There's no significant misalignment of prices or any bubbles that would be at risk once the Fed starts raising rates. So we're going to have to look at what happens certainly with the long end of the curve in the U.S., but more importantly, what is the underlying growth momentum in the U.S. around which the Fed decides to raise rates? Because if growth momentum picks up in the U.S. and exports start to pick up, that's going to benefit the EM story as a whole.
Okay, Gerardo, thank you so much. What a great day to have an update on the emerging markets. He is with BlackRock as well.